Hi viewer, my name is Imran. I'm a UK and cross-border taxation specialist. So the purpose of this slide is to explain the viewer what are the tax implications if an employer pass an asset to an employee for private usage, and also in case if an employer pass on permanent basis to an employee any asset, so this will have tax implication. So the purpose of this video is to explain any tax implication of transfer of asset, and I would explain to you how you would calculate, how would you answer this kind of question in your exam, even in real life. If someone asks you a question, if you're working as a chartered accountant, an employer asks you a question, and they wish to know the tax implication. So by reading these slides and listening to what I'm going to tell you would help you to understand the mechanism. This topic is highly tested in ACCA, ACA, and CTA exam, and also useful for employer if they give an asset and they wish to know the tax implication of provision of the asset to their employee for private purpose. There's no tax implication if is for the reason of the for the business reason, so there's no tax implication. So what is transfer of asset new? So when it's new, so the benefit mechanism would be, so the benefit will be higher of the market value of asset at the date it was transferred to employee, and the market value of asset originally lent an employee, and this will be reduced by the amount already subject to income tax. So you will choose the higher figure and apply the tax rate. So any payment made to by the employee to the employer can be deducted. So what are the assets? Asset could be the furniture, computer, TV, car, bike, and even a house or camera. So there's an example. So if an employee was lent a painting on 6th of April 2020, so remember the dates because it's very important to focus on the question, because the examiner can play around with the question, so you need to be vigilant. So with the market value of the painting was 50,000 at that date. So on 31st of December, employer allows the employee to keep the painting. It's worth now 40,000. So remember, it was given on 6th of April. So from 6th of April 2020 till 5th of April 2021, that is already 1 year gone. So there will be one tax charge. So we'll obviously at the rate of 20%. Remember, even if the employee is subject to higher tax rate, which is 40%, or additional tax rate, still you will calculate the charge by using only the basic rate, which is 20%. So just remember that rule. In exam, you won't get this in the tax table. You have to memorize it. And then obviously what's happened is then in 2022-23, the asset was permanently passed to employee. The ownership was passed to the employee. So and that will happen after. So obviously the usage was for 9 months. So 50,000 multiplied by 20%, and you need to proportion. So the tax charge for keeping the asset for that period was 17,500. So the benefit will be the higher of the tax. So market value at transfer 40,000, and the original cost, obviously remember that 50,000 minus the amount already subject to tax charge, so that's 17,500. So you need to choose the higher between 40,000 and 32,500. So that obviously you will choose 40,000, and this would be reported on your P11D. Remember, £7,500 is the additional tax because it was given on 31st December 2022. So for the 9 months, there's already a tax charge. So transfer of car. The car one, it's slightly worth different than furniture, camera, or painting, because the car is, remember, if you go through my previous slides, in the previous slides, I explain the car benefits. So provision of car benefit. So the car will be usually, or will be definitely benefit will be calculated based on CO2 emission, the list price. If you go through my previous slides, it will explain to you in more detail. So when an employee has been given a company car and later the car is transferred to employee, usually happen when employee is made redundant or when the employee leave the company, and as a gesture of goodwill, the employer can ask the employee just to keep the car. So this would result in a taxable benefit. So the benefit will be based on the market value, the second-hand value of the car at the date it was transferred, and deduct any payment made by the employee for the transfer of the car. So the rules regarding the amount previously charged to tax does not apply here. Make sure you don't do the other calculation. So when it's car, just the simple rule is, because when the car was given to an employee, so the benefit will be calculated by using the provision of car based on CO2 emission and the market, the value when it was brand new, registered by manufacturer. And so the same rule would not apply here. So you would apply the rule is the market value of the car, second hand value of the car multiplied by the tax rate. It will go on P11D. So the use of computer is quite straightforward. If a computer equipment has been provided for a private purpose, this will result in the taxable benefit, again 20%. So it can include uh, printers, scanners, modems, and other similar equipment. Okay, it does not include land rental to facilitate use of internet. Um, if computer is provided for business use, there's no taxable benefit. Difficulty arises when there is a mixed usage. For example, if an employee using for a private usage and also for a business, so then it's going to be slightly complicated. Make sure that you deduct the business element, because the business element is not taxable. Okay, so there is an example. Now, ABC Limited provides Charles, an employee, with a computer along with other accessories. So the total cost is 6,000. So in this case, Charles used equipment 80% of the time for the business purpose. So remember, you remove that business element because the business element is not subject to tax. Obviously, it's an employer responsibility to provide equipment to employee. So for the reason of the business, so there's no taxable benefit. The taxable benefit only arises if there's a private usage. So when you're calculating this kind of question, so cash equivalent always use 20%. So 6,000 multiplied by 20%, so that's 1,200. Remember, remove the business elements. So business element is 80%. So simple as that, only 20% will be taxable. So no benefit charge if the private usage is incidental. Incidental is like if you're checking your email, it's just mere, not like a constant. Sometimes the employer policy might say is you can use it to checking your email. So there's no other usage apart from checking email. So there will be no taxable benefit. Some employer might just prohibit an employee even just from a simple browsing, and they will say to you, you need to work on there's some micro system, and the private usage would be like totally prohibited. So once again, transfer of assets result in the taxable benefit if there is a private usage. So be careful, just read the question. If it's related to the car, different rules. If it's related to other equipment, there's a different mechanism. So you need to go through the slides. If you have any question, please drop me comments. And I forgot to mention one more thing is any benefit will be reported on P11D form. So on the P11D form is a form that is used by like used by employer to report any benefit to the HMRC. So on that form, the employer will list the employee name, date of birth, national insurance, or the detail. And then once it's been filed, the HMRC would automatically know which employee received the benefit. So the employee will be subject to income tax that will be payable by 31st of January following the year in which the benefits were provided, and the employer will be subject to employer NI. So the deadline for submitting P11D is 6th of July. So any employer NI must be paid by 22nd of July, paid electronically. There is no employee NI on provision of benefits. Thanks for watching. Please subscribe to my channel. If you have any query, drop me a line or two and I will get back to you. Have a good night.